All right, good evening, everybody. It's been a while here, especially for the February class. Starting another class very soon. I just want to like wrap up one or two things with your class. Um, okay. All right. Uh, so we've said so many things, but there's something I want to like point your attention to tonight. See, there are key things in technical analysis you must know very well. You must know your entry. By your strategy, what are your entries? You must know your entry. You must know your stop loss. Where are you going to be putting your stop loss? Now you must know your exit. Your entry is very, very important. And that's what most strategies emphasize. Your entry point, what do you see before you enter a trade? Some that use indicators, some use RSI. When this one cross this one, I'm going to be buying. When this one crosses one, I'm going to be selling. Like I explained to you when I was teaching you EMA, and I said that when red line cross the blue line from down up, buy here, and I told you, your buy is at the closure of the candle, the first candle when those lines were crossing. That is your entry. That is your entry. And I also told you about your exit. I mean your stop loss. Your stop loss is where the last swing. I told you the last swing of after the crossing. What is the last swing? The last previous swing. Okay. And I told you that your take profit is within the previous swing, within the previous swing. So I've taught you. So and that's what in most cases your strategy should entail. But see, many people have issues with all of these things because of the emotion involved. But sometimes it does not favor them, especially when something goes wrong at one particular time. People just feel like, okay, strategy is wrong. Let me modify it. Sometimes you just leave it like that, and because the next one might actually work as planned. Okay, like see, I was watching somebody today who said, oh, I shifted my stop loss to break even, and I went to bed. Before I knew it, market came, hit my break even stop loss, and then went in my direction. And the person said when he woke up in the morning, he just wanted to cry. He was just wanted to cry. So it happens. It happens. You see, one thing about having an edge in the market is that you must be mechanical. You must live it. In fact, there's something I learned, sometimes ago that look, I will not, except my profit is in about 50% profit, I'll not come to break even. I just leave it like that. Because I discovered that okay, like the trade that we took at the middle of the night, USD JPY, okay, we discovered that the market and it was a buy. It was a buy at the break of the resistance. We bought and the market was moving up, 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 up. At one particular point, I wanted to like break even. Thank God we didn't. The price came down. Now we're in the red. What we have been in profit before, and then went back in our favor. So market moves like that. Market moves like that. And sometimes you break even, and this was the wisest thing you should have done to achieve that. So you just have to come up with something after you have tested and back tested, and that's why I expect you to do assignment because you see, whatever you have learned, you must master it. The secret is in mastery. The secret in profitability is in mastery. And then discipline, because you see, we cannot talk about discipline except you have mastered something. Because discipline is about, putting yourself to do what you have known to be the right thing to do. But you must know the right thing to do before you start disciplining yourself to do the right thing. I'm telling you. Okay. and it takes a while. It takes a while to actually master, trading financial market successfully. And the moment you master it, you'll be happy for the rest of your life. I'm telling you, be happy. You'll be happy. You'll be happy every week. Many weeks of the year will be profitable for you. Okay, like today now, like this week now, I traded in a couple of accounts, but there's one particular account I said, okay, I withdrew and the money I withdrew. I wanted to empty the account. I just thought, this account, I have $330. I was like, wow, I even forgotten this money in this account. Okay, let me trade on it. So every trade I was placing on my bigger accounts and the account manager, I was placing it on it. Do you know that as I now I'm talking to you now, the $300 as $330, let me see. $330 has turned to $1,030. $1,030. As I am talking to you now, $1,030 is the I took how many positions? One, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I took 11 positions and lost I took total of 12 positions and lost three. I lost three positions. And let me say I lost two. Because this one, it was a mistakenly clicked. So immediately I clicked here, I lost $1.28. So I quickly closed it, but that was not what I wanted to open. It was usually a mistake. So I had 11 positions and I won 9. And how many instruments did I trade? USJPY, of course, three instruments: gold, USJPY, GBP, and those are the three things I trade. You just imagine that's like 300. That's like 300%. Okay, 300% profit. Starting a week with $330, and as I time I'm talking to you now, is $1,030. Aside the other thing, this is just an account I've already forgotten it. Just say, wow, I thought I've emptied this account. I didn't know it still remained $330. So when you master something, when you master a strategy, it can deliver you profit for the rest of your life. And that's why I'm trying to touch every aspect. I've taught you moving average, I've taught you trend line, I've taught you, okay, I've not taught you Fibonacci retracements, and I've already taught you support and resistance. I taught you trend line breakout. These are powerful strategies in the market. Trend line breakout. There are a few other things to talk about, but what you've been taught, if you have mastered them sufficiently, okay, they are capable of making you profitable in the market. Capable, big time of making you profitable in the market. Now, tonight, anywhere you want, you look at in taking an entry in the market, we call that particular spot area of interest. Area of interest. Area of interest. And the area of interest, there are certain candlesticks that you must always look forward to. You must always be looking at when they are formed in those areas, if they will buttress your bias. For example, I'm looking at a trend line, an upward trend line, and sometimes I'm looking to buy. I've already drawn it. I've drawn my point 1.2. And I'm going to buy here. I'm going to buy here. Now, at that spot where I'm looking to enter at the touch of the trend line, when I'm expecting price to bounce to the upside, there are certain candlesticks that when they are formed here, they will give me strong confirmation that, oh, it's time to buy here. It's time to buy here. And those are what we call the reversal candlestick pattern. Reversal candlestick pattern. Reversal candlestick pattern. And that's what I'll be introducing to you tonight. Maybe I will record in details a video for you tomorrow and see how I can how I can make it more elaborate. Okay, so let me quickly share a little things with you on my screen here. Yeah, beautiful. So there's something we call area of interest. Area of interest, AOI, area of interest. I used to call it dawn zones. Many of my old students know zones because I named it after myself. Dawn zones. Now you see the support and resistance. Okay, so if you have a support and resistance, if you have a support, I told you when the market is ranging, you buy at 12 or AMA. okay, at the support, at the support, at the support, or piercing candle, okay, at support, or the morning star at the support. These are the candles that you look out for to confirm your bias before you now enter a trade. Because you see, if you want to enter a trade and then at the support level, you want to enter a buy. At support level, you are seeing a bearish engulfing. You're seeing the bearish engulfing. Oh, you need to check. I mean, you have to hold on to see if the next candle is going to be breaking that support. Then that support may not be holding again. So we call them area of interest. The same thing happens for resistance. Price got to your resistance and you're expecting the price to go down for a sell. You're expecting the price to sell. And at that point, what are the likely candle you're going to be looking for? Number one, you'll be looking for shooting star. You'll be looking for shooting star. A shooting star is a bearish reversal candles, or you're looking for bearish engulfing. You're looking for bearish engulfing, or you're looking for hanging man. You're looking for an hanging man, or you're looking for dark cloud cover. Those are kind that give you signals to sell. Dark cloud cover. Or you're looking at the evening star. You're looking at evening star. And all of this kind of give you an indication that look, oh, come on here. Oh, come on here. This is confirming my bias. Then I think I'm having much more confirmation to enter a sell at this resistance. So those are the things that you look for. So where do you look for this? Number one, at support and resistance, at trend line touches. When your trend line touch, it's not showing. Okay, so it's showing again. So at the trend line touches, I'm looking for these candlesticks. Don't forget the candlesticks. Number three, demand and supply zones. Demand and supply zone. The difference between demand, support and resistance, and demand and supply is the word zone. They mean the same thing, but just that we are covering, our eyes are focusing on a zone, not just a line, not just a price. That's just the difference between support and resistance and demand and supply. Then we have Fibonacci retracement levels. So when you draw your Fibonacci retracement, at those levels, 21, you are dropping 50, 38.2 and then 50, and all the Fibonacci retracement levels. When you look at those levels, the candles forming at those levels will confirm your bias. Okay, if I draw it, if it's an uptrend, as we're looking for, just like I said earlier, a pin bar, looking for a bullish reversal, a bullish engulfing and the likes, so that it can confirm my entry. So these are sometimes too, you can actually, the other time too, you wake up at the beginning of a session, London session, New York session, and then you are seeing, for example, at the beginning of a London session, you are white soldiers, there's a candle called three white soldiers. Every time you see those three white soldiers, is a bullish reversal candlestick. It's a bullish continuation, actually. Bullish continuation, candlesticks. When you see those three candles, they just follow each other. They are full. They are full candles. I'll be showing them maybe in the call, maybe sometime later if time still permit. Okay. Okay. Then then you see at the beginning of a session, maybe New Year session, you just see those candles. I tell you the price is still going in this direction. So you can use them at the support and resistance. You can use at the touch of trend line. You can also use them at Fibonacci retracement level. You can use them at the opening of a session. At the opening of a session, you can also look at them during the news. Those candles forming, you see, during the news, they can also be very, very, those are the time you look for these reversal candlesticks. So the most reliable reversal candlesticks. Before I used to teach plenty, but now I think I've reduced them to very few. very, very few reversal candlesticks. So we'll be touching those few reversal candlesticks in the course of this class, and then we'll continue from there. Now, first of all, I need you to understand that every single time in the market, I need to understand that every single moment in the market, two forces are at work: the bulls and the bears. The bulls and the bear. Okay? The bulls are the buyers, the bears are the sellers. And every single time we have buyers, we have sellers. The only difference is, when the market is bullish, it means the bulls are gaining upper hand. There are more orders to the buy side than we have to the sell side. More buyers, more bullish, more buyers to the sell side. You know, when the market is selling, we have more volume, more orders to the sell side than we have to the buy side. The same thing happens when the market is bullish. We have more order to the buy side than we have to the sell side. Okay, so you now need and if you have more volume to the buy side, then the market is bullish. Then you start forming higher highs and higher lows. Then you join the uptrend, and the opposite is the K. Opposite is the same. When we have more orders to the sell side, the price start forming lower highs and lower lows. Then you look for a way to enter to join the sell. First of all, I need to understand that at very single moment in the market, two forces are at work: the bulls and the bears, the buyers and the sellers. When the bulls are having upper hands, you will start seeing candlesticks, and that shows you start seeing green candlesticks. That shows upward price momentum. Upward price momentum. The reverse is the case when the bears are having upper hand. When the bears are in control, you will begin to see red candles. Before you start looking for reversal candlestick, you should look for area of interest. The first thing you want to know is your area of candlestick are only relevant on the area of interest. Please don't forget that reversal candlestick, because that's a mistake some make. They just look for reversal candlestick at anywhere in the market, and then they feel like, oh, I've seen it. No, 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 no. Reversal candlestick are only relevant when they are formed at your area of interest as a confirmation to your bias. You already have a bias, you're already expecting what you're looking for. For example, you have drawn an upward trend line, and then you're looking forward to buy, and then you now see a bullish reversal candlesticks that confirms your buy. So you don't just pay attention to the reversal candlestick formed at anywhere in the market. You pay attention to them when they are formed on a particular spot in the market. So general rule: the higher the time frame, the stronger and the more reliable the reversal candlesticks are, and that's very true. Very true. The higher the time frame, okay, the more reliable the reversal candlesticks are. Meaning, the reversal candlestick you see on M15, that's 15-minute time frame, is stronger than and more reliable than the one you see on M5. And the one you see on H1, 1 hour time frame, is stronger than the one you see on M15. That you should never forget. Because why are we saying this? Because on lower time frame, there's much noise, and the integrity of reversal candlestick is not as strong as when they are formed on the higher time frame. So there's so much noise on lower time frame. So the higher the time frame, more dependable, the more you know the more reliable reversal candlestick can be when they are formed on the higher time frame. So pay attention to it, because you see, for example, it has happened to me before. I saw a reversal candlestick on 4 hour time frame. I'm telling you, I saw a reversal candlestick on 4 hour time frame, 4 hour time frame, and I enter my trade. And I told myself, I said, look, there is nothing this trade, I can't lose this trade. I know of course, I know that probability is always there when you enter a trade. But this one, do you know that trade I entered it on Thursday. The trade entered profit the following week Tuesday. The following week Tuesday, because I know this reversal candlestick I saw on 4 hour time frame. It really feels. It really feels. It really. So I left it there. Thursday afternoon, I entered the trade. Friday, still in negative. Monday, in negative. Tuesday, the moment I entered profit on Tuesday, it just start running. Because it wasn't a major pair. I think it was an exotic pair, not even a minor pair. It's an exotic pair. An exotic pair. Then and then so let's begin from here. The doji candlesticks. Doji is a kind of reversal candlesticks, and which 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 you must pay attention to when you're looking to enter a trade, when you're looking to enter, a trade in the market. So doji literally means a point of indecision in the market. It literally means a spot in the market when the buyers and the seller agree on the same price. When they agree on the same price, it's the point of indecision in the market. Nobody is winning. The buyers are not winning, sellers are not winning. Okay, but um, why? Because they both agree. They both agreed at a particular price. So nobody is having upper hand. It means that the price that the sellers are willing to sell is the same price that the buyers are willing to buy. So we have like an equilibrium moment in the market. So doji candlestick have five variations. We have five variations: the common doji, the long-legged doji. This looks like theory, but it's very practical. It's very, very practical. Don't worry, we'll get there. The common doji, the long-legged doji, the dragonfly doji, the four price, the gravestone. I love this candle. See, these candles, chai, 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 chai. It's one of the candlestick that can make you a lot of money in the market. I give you a lot of confirmations. I'm telling you. See, you need to understand that the chart is literally candlestick pattern, as in candlestick, market language. Like I explained to you the other time, your profitability in a market will be determined by how well you can analyze candlestick anatomy, candlestick formations. I'm telling you, because to see, it will give you, for example, today I think I was in the office and I traded USA 30 today and I traded GBP USD, USA 30, GBP USD. Those are the two instruments traded today, USA 30, GBP USD. The GBP USD, I was just at the point I was waiting, just waiting at that was at the New York session. That was